Hello, good afternoon, and welcome back, everyone. My name's Anthony Newgrosh, and thank you for joining us for the latest BKL tax webinar. We've decided to give David Wiscombe the day off, but I'm delighted to say I'm joined by our new recruit, David Simpson, who is stepping in, I'm sure, ably into David's shoes today. So, David, welcome.
Oh, welcome. Thank you, Anthony. I have to say I'm excited to be making my debut. The weather's rather inauspicious, but hopefully that means you've all got your lunch in front of you and you won't be tempted to leave the broadcast.
So welcome aboard. David joins us as our new business tax partner, does a bit of international tax. Any other little niches you'd like to admit to, David? That's about it, is it? Okay, but I'm sure David will get to know a few of you in the weeks and months ahead. So David, what are we talking about today?
Well, today the topic is entrepreneurs relief and investors relief.
And may I first of all say, good use of apostrophes there, very impressed, so thank you, you passed the first test. So we're not going to revisit everything we've previously talked about. We've done webinars in the past on entrepreneurs relief and investors relief. They're on our website and readily available if any of you would like to revisit those. But we're going to focus on, well, why are we focusing on those today, David?
Why these topics now is a good question. Obviously, there were some fairly significant changes to entrepreneurs relief in the Finance Act, and we'll run through those. And I think we'll also use the opportunity to revisit a couple of old chestnuts which come up time and again on entrepreneurs relief.
Okay. And what about investors relief?
And investors relief is, of course, the forgotten relief. It was actually put on the statute books back in 2016, but because it actually takes 3 years of holding the shares to be able to make a claim under the relief, that first claim is potentially comes around on the 6th of April. So it's actually a relief which becomes active as of next tax year.
Okay, never dull. So we'll start by looking at entrepreneurs relief. I'm sure we're all aware there's been a fair amount of froth of late on the changes that were announced. For once, as David I'm sure will explain, HMRC have rowed back a little, but more on that in a little bit. Let's just remind ourselves, David, about roughly how entrepreneurs relief works without going into all of the nuts and bolts at this stage.
Okay, I've sort of highlighted 4 points here, and we will go through these points in some more detail. The first point is you still have to be an employee or a director. The shares have to be held in a trading company. You're still required to hold 5% of the ordinary share capital, unless acquired by way of the exercise of an EMI option, and you still have to have 5% of the voting rights by virtue of that holding.
Yeah, and the legislation is quite specific on that last point. You can't have 5% of the voting rights given to you by any other means, can you? It has to be specifically by virtue of that holding. The wording is quite important there. So those are the main conditions. Paul's asked director or officer. I think he's absolutely right. When we say director, you can also be company secretary, an officer of the company. That will work for those purposes. But maybe let's just talk about that point. We talk about employee or director. I think we all know broadly what those rules means, but there is a little bit of wiggle room there, isn't there, David?
I think if you look at the first 3 bullet points, the first 2 points have a surprising amount of wriggle room. And in my experience, actually, it's the third point which causes most of the problems, because that is a bright line side.
Okay.
But going back to the first point, one might think employee or director or officer of the company, to be more correct, was a straightforward test, but as always in tax, the case law actually suggests otherwise. I think what's happened in family situations, the arrangements can be fairly informal, and people, for instance, can simply forget to be appointed formally as director. Now, what has transpired from the case law, as many of you will be aware, is that director encompasses both a de jure director, where the individual has been formally appointed,
okay,
but also a de facto director and a shadow director. Both of those terms are defined by the Companies Act.
Okay.
And there's actually been a couple of cases where the revenue, I think, initially resisted this. these couple of cases came along, and actually as a result of those, although neither of the individuals actually won on the point of being a director, the revenue, in my experience, are now open to accepting an individual can be either a shadow director or a de facto director.
Okay, so the point that you may not be legally appointed as director and registered as such at Companies House, clearly unhelpful, but does not necessarily completely hold you beneath the waterline, I think is what we're saying here, David.
Yes, I think you don't want to get yourself into this position.
Ideally not.
So if in any doubt, make sure you're actually formally appointed as director. But the trouble is, most of these things happen after the event. People notice that the paperwork hasn't been filed. So it doesn't mean that you necessarily have lost the entitlement to ER. The other point to bear in mind, which was actually came out of the cases as well, is both individuals were actually successful in claiming entrepreneur's relief, but not by virtue of being director, even though both had actually resigned as employees. In both cases, it was actually held that the employment relationship continued to subsist, and they actually won on the basis of continuing to be employees.
So again, the fact that you may not have a formal employment contract is not definitive, but as you say, why pick a fight? Get the employment contract in place and don't do the revenues work for them. We've seen examples where people have resigned the day before they sell their shares, for example. Again, you might argue they were still acting in the capacity as a director up to the point of sale, but not helpful.
Exactly.
Okay, so bit of wriggle room there, but certainly ones to be avoided where possible. Let's talk now about what we mean by a trading company. And again, we're not here to delve completely into all the nooks and crannies of entrepreneurs relief. Broadly, we mean company or group for these purposes, don't we, David? But let's just explore a little bit further exactly what we mean there. David's just asked a quick question. Hi, David. I assume that company secretary qualifies, I think is the gist of his question. I think the answer to
that is yes, as an officer of the company.
Yep. So, okay. Right. So let's move on to a trading company, or for all intents and purposes, a trading group. What do we mean here, David?
Yeah, well, you'll see I called it the high bar definition. That is my own personal moniker. It's to distinguish this from the 51% test, which is used for some other purposes of the Taxes Act. The ER definition is not the 51% test. I've put the test down on the slide. It is a company whose activities do not include, to a substantial extent, activities other than trading activities.
Okay, now, that's what the legislation says. It doesn't really tell us a great deal more, does it, insofar as substantial is not statutorily defined, although the revenue indicate quite clearly we mean 20%, albeit we have the substantial shareholding exemption where substantial in that context means 10%. So there's all these little words with different implied meanings here, but 20% by reference to what, David?
Well, it's a classic tax definition, and it leaves you asking the question, well, what does the definition itself mean?
Mm-hmm.
As Anthony's touched upon, the revenue interpret this as an 80% test, I think, is the very loose rule of thumb. 80% of what? The revenue actually ground their approach in some case law drawn from inheritance tax cases, which rather ironically was looking at the 51% test.
Okay.
But the sort of conclusions which they've probably quite rightly drawn from the IHT cases is that you need to look at things in the round, and in particular, and in doing so, you would consider the income of the company, the asset base of the company,
director's time, I think.
And I think probably the single most important one, management time, mm-hmm. and then just the history of the company as well. And you put all of those together, and it comes up to, does this look and smell like an 80% trading company? I think the point to emphasize here is that failing on one aspect of it, so let us say the asset base, doesn't mean that you failed the test. It means you've failed one of the four primary indicators. So even just stopping there, you may still pass the test.
And to be fair, the revenues manuals specifically make that point, don't they? So the revenue do accept that. I think their phrase is look at it in the round, albeit, you know, if you've got £1 billion of investment properties, that clearly isn't helpful, but you might still have an argument if you're lucky.
And obviously it's also worth reiterating that unless you've got a transaction in the offing, you can actually write to the revenue in cases of serious doubt and actually get their opinion on it.
You can.
But my experience is this question really becomes critical in the run-up to a transaction, and whether you really want to involve the revenue in a situation where you might get a negative response is debatable.
Indeed. And yeah, you may wish to consider whether you wish to raise your head above the parapet in such circumstances, but you can go for a ruling from HMRC under their non-statutory provisions for business tax.
Well, one particular point to do with entrepreneurs relief, the TCJA, which is the Taxation of Chargeable Gains Act, has special provisions dealing with joint venture companies. Those special provisions are themselves amended for the purposes of ER. So if you're actually looking at a situation where you're relying on the activities of a joint venture company to qualify you as a trading company, just be aware there's another level of special rules behind that need to be considered for ER purposes.
And similarly, if you have a company that has an interest in the partnership, now the rules were amended in Finance Act 2015, I think, David. They didn't do a very good job. They amended them in Finance Act 2016 with retrospective effect to try and correct the mess they made in the previous year. I have to say it's extraordinarily complex legislation, a little bit outside this talk today, but we would be happy to assist as necessary on that. So do be careful with joint venture companies or partnership interests of a company with which you would like to claim ER. Now, one point that has always caused difficulty, and I don't think it's ever been sort of put beyond doubt, is this point about excessive cash in a company and whether that could taint your entrepreneur's relief qualifying status. So could it mean that you are no longer considered a trading company? David, today is the day we put this beyond doubt. No pressure.
So let's take the situation where you've got a balance sheet of $1 million and 300,000 of that is cash. Yep. So applying my little rule of thumb, that's above the 20% threshold for substantial. Again, I would reiterate, just on its own, that's not necessarily fatal because it's only one of the four criteria the revenue would look at. But let's say for these purposes, we're concerned about it. I think for a trading company, the first thing to note is that you always have to adjust for unrecognized goodwill in the balance sheet. So if I've got my £1 million balance sheet and I'm looking to sell for 10 million, that suggests that there's £9 million of unrecognized goodwill on my balance sheet. And once I adjust for that, my excess cash problem goes away.
Fair point.
So I think that's sort of point number one. But let's say we still can't get below the 20% even after adjusting for excess cash, for unrecognized goodwill. And this will often be the case where in the couple of years leading up to disposal, you've tried to strengthen the balance sheet and you've actually retained cash, and perhaps with an idea to the fact that you want to extract it at 10% rather than at dividend rates. Cash as cash. Well, first of all, what do we mean by excess? This is not cash that's held for a temporary purpose. So for instance, you haven't just sold an asset and happen to have cash at the balance sheet date. And it's also not cash that is there, that is mounted up simply because of the trading cycle. Many businesses will go through a period where cash is accumulated at one part of the cycle and then expended later on. In neither of those situations would we regard that as excess cash. So what we're talking about here is cash that is identifiably surplus to immediate business needs.
So go on. What are we going to do with that cash, David?
So again, is it a problem? In my experience, the revenue tend to be fairly relaxed about this if it's kept as cash in liquid format, i.e. not in term deposits, and it's been generated from trading operations.
Yeah, I would have to agree with you there. Look, clearly, if the cash is put on long-term deposits, it would be difficult to argue it is there to support the working capital of the business, and that cash could be considered a non-trade asset. But as you say, that only taints your balance sheet. Let's also be clear, the legislation talks about, do you to a substantial extent undertake non-trading activities? Now, the passive holding of cash, it is hard to construe that is an activity. But I think best practice says, look, make sure you can justify why you've got the cash, where possible, that it is needed for working capital. Don't shove it on 10-year deposit, which again might suggest it's not available for the business. But also bear in mind, we're not back in the days of taper relief where you have to look back, what was it, 10 years to the status of this company. For entrepreneurs relief purposes, subject to what David's going to enlighten us on, you look back at the moment just 1 year. So you've still got time to clean up your balance sheet potentially, unless somebody knocks on your door. I think Kevin Slevin also wrote a very good article on this on taxation. He applies the duck test. Does it walk or talk like a trading company? So I think on a scale of 0 to 10, I'm going to put you on the spot. Cash on the balance sheet, how much of a problem do you think it is? 10, huge problem. 0, not a problem, David. I know that's an unfair question, but
I tend not to lose sleep over it if we're talking about liquid cash.
yeah, I would agree with that. So
one point which I would mention, though, is the tension here between securing ER for CGT purposes and business property relief for inheritance tax purposes. The revenue do take the point for BPR purposes, business property relief purposes, that excess cash is not a qualifying asset for business property. And the way around that is to actively manage the cash for inheritance tax purposes.
So it's a business in its own right. Yeah, fair point. But
the trouble with that is that would not be a qualifying activity for CGT purposes. So there is a bit of tension. Hopefully the fact that you're looking at only a 12-month, or to anticipate what's to come, a 24-month qualifying period gives you enough visibility to manage that point going forward.
Okay, so that's cash. I think that's about all we can say on that. Let's move on then. Let's say cash is a problem. But we've also got our final point, which is this 3-year look back, our get out of jail card free, David, haven't we?
Yes, having got to a position where we're relatively comfortable about cash, we become even more comfortable about it, particularly in a situation where cash is accumulated in the 2 or 3 years just prior to disposal. The normal disposal rules that we are discussing today are known as Condition A within the terms of the legislation, but there's also a Condition B. And Condition B is such that if you had a qualifying company, so it satisfied the 1 year, but then it ceased to be a qualifying company, and in our example of this scenario we're talking about, it ceased to be a qualifying company because of excess cash, you still get entrepreneurs relief as long as that disposal takes place within 3 years of the date when it ceased to being a qualifying company or trading company.
I think the important distinction, the legislation doesn't say the company ceases to trade. It says the company ceases to be a trading company as defined for entrepreneurs relief purposes. Now, I suspect this provision was designed for companies that were being wound up and to give people a reasonable period of time to liquidate the company, subject to the TAR, that's another talk, and still get the benefits of entrepreneurs relief. But absolutely, that's the wording in legislation. I think it's clear. So even if you do fall over, you've not completely lost your entrepreneurs relief. You may still have 3 years in which to salvage the situation, as it were.
So hopefully that gives you some confidence that actually, for the 2 tests that we've just been talking about, despite apparently looking reasonably strict and definitive, both actually have a fair amount of wriggle room.
Yeah, I think I would agree with that. And let's, on that basis, crack on to what potentially could be a more significant problem, which is the definition of ordinary share capital. Now, this is important because it's got to be your personal company, and personal company is defined, David, as having broadly 5% of the ordinary share capital, which gives you 5% of the voting rights. But on that basis, we need to be very careful about what we mean by ordinary share capital.
Yeah, and as I mentioned before, this is particularly crucial because this is a bright line test. You either have 5% of the ordinary share capital or you don't, and the revenue will take the point. Now, ordinary share capital, despite sounding quite innocuous, is a defined term, and you'll see on the slide that I've put the definition down there. So it's all issued share capital other than capital, the holders of which have a right to a dividend at a fixed rate, but have no other right to share in the company's profits.
And that's it, word for word, isn't it? And I think that comes from ITA 2007, section 989, isn't it?
Oh, I'm very impressed.
Yeah, I think so.
It was. I should say we hadn't prepped this in advance. That is plucked from the depths of Anthony's mind.
I just made it up, but sounds believable. No, I think that's right. So as you say, quite a straightforward definition on the face of it, but
it seems fairly innocuous. So what I'm proposing to do, I'm going to just pull up 4 examples one at a time, and I'll pause after each one. We're not going to take a poll, but we'll give you a couple of seconds after each one to see whether you think the shares in question would be ordinary share capital.
We should have done a poll, actually, shouldn't we? Well, maybe we'll do that next time. We can do polls. So this is David's first example. So bearing in mind that definition, shares with no entitlement to a dividend, or what does that mean? A fixed rate of 0. Does that meet the definition of ordinary share capital? And the answer, David, is?
Well, interestingly, this question was bounced around for years, actually, within the profession. And actually, it ended up being litigated. We had a situation where some shareholders holding what were unquestionably ordinary share capital were forced to litigate because another shareholder had shares that were effectively had become deferred shares. They had no dividend rights. And they wanted them not to be ordinary share capital because if they were, the shareholders who were litigating were going to be diluted below the 5% threshold. And rather surprisingly, the first-tier tribunal actually held that shares without dividend rights were not ordinary share capital in the first instance.
Because they had an entitlement to a fixed rate of 0.
Exactly.
Yes. Okay, yeah.
That caused some surprise, it has to be said, and the Revenue appealed the decision, and in the upper tribunal, the decision was reversed. So where we are now is that shares with no entitlement to a dividend are ordinary share capital. And the reason for that is 0 is not a right to anything. So it's not a right to a dividend at a fixed rate.
Okay. I mean, you can see the argument both ways, to be fair, but I think that's probably right, isn't it?
And you do come across shares like this fairly often. So in doing your arithmetic, just be aware these shares count.
Okay. So that's a fixed rate with no entitlement. Well, sorry, let me rephrase. No entitlement to a dividend or a fixed rate of 0. Our second example is, what about fixed rate preference shares? Now, don't rely too much on the word preference in there. It's not what they're called. It's what they do, as it were. But these are allegedly fixed rate preference shares with a token coupon. So 0. I don't know how many zeros you've got there, but lots, 1%. So they are ordinary shares, David?
Again, just a couple of seconds to allow people to make up their own mind on this.
A dramatic pause here. We'll talk about the cricket or something for a minute. Okay.
Now, in a world where tax has moved away from form over substance, this is an exception. So if you have no entitlement to dividend, it is ordinary share capital. But if you have a positive fixed rate, no matter how infinitesimal that fixed rate is, they are not ordinary share capital in this case.
Yeah, so on a strict reading, yes, I think we'd have to agree with that. So
moving on to the third example.
Number 3 is 10% fixed rate preference shares, but these are non-cumulative. So looks fixed to me, David.
So by non-cumulative, this means that if the company doesn't have the reserves to pay the dividend in the year, the dividend is lost. The entitlement is not carried over to a future year.
Okay.
And the Revenue view on this is that is ordinary share capital.
Shock horror. Because, David?
And the rationale is because your entitlement to the dividend is dependent on the results of the company, it doesn't satisfy that final aspect of the definition. You do share, your entitlement depends on the company's profits.
Not an easy one to see that, is it, to be fair? But, okay, there you go. So our final example, what about cumulative 10% prefs entitled to a premium on redemption, sale, or liquidation? Are they ordinary shares, David? And pause for dramatic effect.
And the revenue view on this one is, again, that these would be ordinary share capital.
Because
Now they're happy that you've got an entitlement at a fixed rate, but because you can get a premium on the redemption, sale, or liquidation, in the revenue view, that is an entitlement to share in the company's profits otherwise and through the fixed rate payment.
yeah, I can kind of see that. Again, I don't think it's immediately obvious, but yeah, I can believe that one. So just be careful. And it's not going to be relevant too often, but I think this is an area where it is easy to fall down, and we don't have the same wriggle room that we talked about before on whether you're an employee stroke director or whether it's a trading company. This is, as you say, you're either in or out, so be careful.
And I would have to say, in practice, this is the area, as I mentioned, this is the area where most people get tripped up. And it's not the area where you'll see court cases come through that often, simply because once it's been identified, none of these are particularly controversial, and I think it's just recognised that you will have failed the bright line test in that scenario.
Okay, so what we've talked about so far is nothing really new, as it were. We're just highlighting some of the issues that have really always been there. But let's now move on, David, and talk about the changes that have been announced and largely take effect from, well, 5th of April, but we'll let you explain. So, in summary, David.
So this is the exciting bit that I'm sure you've all tuned in for. It was so that there's three principal changes that we're going to touch on: the qualifying period itself, the new relief for known as dilution relief, where you're actually diluted below the 5% holding as a result of a cash subscription into the shares, and then the alteration to the 5% test, which I think is the change that caused the froth to which Anthony referred earlier, and for which the revenue of actually, to the credit, listened and rode back a bit.
Indeed, indeed. Okay, let's talk about the qualifying period first, David. So, reminders of the change there.
Okay, this in some ways it's the most important change, but in other ways there's not much to say about it. The qualifying period is being increased for disposals from the 6th of April to 2 years from the current 12 months. So if you sell on the 5th of April, you need to have been qualifying for 12 months. If you sell on the 6th of April, you need to have been qualifying for 2 years.
Yeah, and I think it could have been worse, I think, is the general feeling, isn't it? It shouldn't be too onerous, and I don't think that's too unreasonable in my humble opinion.
Well, it's certainly going to speed up a lot of transactions that are looking to complete around now. I mean, I think if we take a step back from these three changes, Anthony,
yeah,
Entrepreneurs Relief has been under a fair amount of pressure at Westminster. The Public Accounts Committee have gone after the revenue in respect to the costs associated with this relief. One would hope that if you take a step back and look at the changes taken as a package, the quid pro quo from this is that the pressure will be relieved at Westminster, and actually the relief itself will fundamentally survive as a result of these changes.
I think that's a fair comment. I'd agree with that. So it's just a bit of a delicate slap. I think we'll take it and move on, as it were. So qualifying period is now extended to 2 years from the 6th of April. That's the headline there, isn't it, David?
It is. Now, the one exception, and because this is tax, there's always an exception. We mentioned the condition B on a previous slide. This is the situation where the company has ceased to be a trading company, but you're still within the 3 years where you can make a disposal in which you can claim Entrepreneurs Relief. If the cessation has happened prior to the 29th of October, the qualifying period remains 1 year at that point.
And that was the date these changes were announced, wasn't it? So it's to try and avoid any sort of retrospection, I think, is the point there.
Which opens up an interesting scenario that, let's say you're selling post 6th of April and you don't have the 2 years at that point, but you do have the 1 year as of 29th of October, and you've got excess cash in the balance sheet. You could actually be in a situation where you're trying to argue that the excess cash caused the company to cease to be qualifying, some point where you've got the year, but you don't have the 2 years. Interesting.
Yep, haven't thought of that, I have to admit.
Okay. Again, it's it's a transitional argument, but we'll see if we have to address that one in practice.
Okay, we'll leave that particular straw for now. I think let's talk about what we've called dilution relief next. I don't think it's specifically referred to as such in the legislation, is it, David? But that's the principle, and I think just to flag up one other point, this is where you are diluted down below 5%. The other exception to not having to have 5% of the equity is if you acquire your shares under a qualifying enterprise management incentive scheme, and I think you had to acquire them after the 6th of April 2012, if I'm not mistaken, something like that. No one will sue us, don't worry. That's the one exception, but this is to deal with a situation where you have 5, 6, whatever percentage, you bring in extra shareholders and you become diluted down. HMRC acknowledged that in those circumstances it would be a little harsh to lose your ER. So what have they done about it, David?
This is a relief that to me appears unnecessarily complicated, and is if you find yourself in this position, it's by no means a no-brainer as to what you want to do in this situation. So just to reiterate Anthony's point, this is a situation where there's been a dilution as a result of a cash subscription into the shares. The legislation is very specific about that. It has to be a cash subscription which takes you below the 5%. What they're really thinking about is a funding round for an early stage growth company. In that situation, and this is at the level of the shareholder, it doesn't involve anybody else, they've brought in 2 possible elections. To get into the second election, you have to have made the first election, but you can make the first election without making the second.
Which is?
So the first election is that you can elect to crystallize a notional disposal at the time of the dilution with an immediate notional reacquisition of those shares. So basically you trigger a tax event by virtue of this election.
Yeah.
The legislation is very specific. The value you use for this is a fractional valuation, not a minority valuation. So in practice, what you'd probably be using is the valuation of the company used for the funding round. Now, obviously, that valuation basis is significant. I mean, that's using a full valuation of the company is a significantly different figure from a minority valuation figure.
Oh, very significant, yeah. You normally, for a 5% shareholding, looking at what, 80–90% discount, wouldn't you, yep. I think, David? So, yeah, that's going to make a big difference.
So if you make this election, you are creating a dry tax charge, but the point is that charge will be eligible for entrepreneurs relief, and the quid pro quo of that is that you get a step up in the tax base of the shareholding going forward.
Okay, so yeah, I get that.
So obviously that is that calculus where is it worth paying tax now to protect your entrepreneurs relief in the hope that you're saving tax at a later event, but obviously not guaranteed to do so if the company turns south.
Okay, so that's the gamble, isn't it? Do you bank your ER now, or is it a bit like bullseye, come back next week with your darts and have another go? The choice is yours. So there's an election to be made. That's the first election. You mentioned the second election, David.
Now, the second election in some ways addresses that concern about a dry tax charge, but only goes a part of the way. Now, under the second election, you can postpone recognition of the gain arising on that notional disposal until the shares are sold, which sounds like a no-brainer.
However,
but there's a definite but to this one. All this election is doing is saying at the time of that later disposal, you ignore the 5% rule. You still have to meet the other conditions to qualify for entrepreneurs relief. So for instance, had you ceased to be an employee or officer of the company at the time of that later disposal, you wouldn't have satisfied the relief, the general conditions. So therefore, the 10% that you thought you'd banked, you haven't banked.
Okay, I assume, and I haven't looked, David, and I hope you have, it's the normal 31 January following the end of the tax year to make these elections. Is that right?
It's a very good point to raise, Anthony. In loose terms, although it's done by reference to 31 January, it's 2 years for the first election and 4 years for the second election.
So there's a certain degree of, well, at that point you should be a little clearer whether to make the second election, as it were.
Exactly. So I suspect the way this will go for anybody who's affected is you will make the first election and then bide your time to see whether you want to make the second election.
Okay.
I mean, there's an issue of payment is due in between those times, but you do have an element of time on your side on this one.
Yeah, agreed. And in a way, this is quite similar to the elections you can make if there's a reorganisation and you roll into QCBs or non-QCBs. The elections are similar to the first there, at least, as to whether you want to bank your ER at that point as well. So further complications, I think we would accept this is, well, a welcome relief, as it were.
Yeah. But just bear in mind that second election needs some thought. It's not going to work in all cases.
Okay. Right, so that's dilution relief, as we say. A welcome change. We've had a question in from Edith, I think it is. I hope I've got that right. Once you've made the tax payment, would the revenue still allow the second election? So I think the point is there. So you've paid the tax, but then you elect to postpone. I assume you can just say, can we have it back, please, Mr. Inspector?
Exactly.
Very
yes.
nicely.
Yes.
Okay. So let's move on then. So the changes to the 5% test. And this is, as we say, where all the fuss and bother was, David. Calm those waters for us, please.
Well, the policy intention here is unobjectionable. As you will remember from the very first slide, the test for ER was 5% of the ordinary share capital as defined, with 5% of the voting rights that are attached to that. Now, rather curiously, in the initial version of ER, there was never a 5% economic interest test, which of course led to some ingenious tax planning to sidestep the requirement, or to actually meet the requirements without giving a 5% economic interest test.
Yeah. And
the policy has been amended to say, well, we appreciate your efforts in that regard, but we're now introducing a 5% economic test, i.e. you actually have to be entitled to 5% of the proceeds on a disposal. And again, I think there was, if you look at this as part of a package that protects the future of entrepreneurs' relief, I think the policy objective is unobjectionable. What caused the froth, to use Anthony's term, was when they introduced this, they introduced this test, which is showing up on the slide at the moment, and I'll read it, and then we will cogitate upon it. That the individual is beneficially entitled to at least 5% of the profits available for distribution to equity holders, and on a winding up, would be beneficially entitled to at least 5% of the assets so available. Well, this caused two ruffled feathers on two counts. We've just talked in some detail about the meaning of ordinary share capital. It's noticeably absent from this definition that there's no reference to ordinary share capital. Instead, there's a reference to equity holders. Now, equity holders is a defined term that's been brought in from the Corporation Tax Act. It is a much wider term than ordinary share capital, and it can include, in some circumstances, preference shares, which would otherwise not be ordinary share capital, and it can actually include debt in some circumstances.
Yeah, it's quite a complex definition, isn't it?
So suddenly we're measuring the 5% against a completely different definition. And the other problem with equity holders coming from a corporation tax environment was in the corporation tax world, it works by reference to accounting periods. And it certainly wasn't clear to me how, and to many other commentators, how it was going to be adapted to a transaction-based event like a share disposal. However, the main problem with this definition is the reference to entitlement, particularly in the private company scenario where alphabet shares are not uncommon, and the normal articles of a company will give the directors discretion to declare differential dividends, should they so wish, on any of the classes of alphabet share. And in a strict reading of that legislation, in a company with alphabet shares, no one would be entitled to 5% of the profits available for distribution. So on this definition, on many private companies, no one would have been entitled to entrepreneurs' relief.
Yeah, I mean, there were counter arguments, weren't there? But that was the major concern, and HMRC did nothing to assuage those concerns initially, did they?
I mean, I think it was going to be a scenario where I think the legislation was quite clear that nobody did have entitlement, and it was going to be the legislation with tax on the revenue would be required to relieve by concession, which is not a very, we do have that in some situations, but it's not a very satisfactory position.
Okay, so to cut to the chase, what did they do about it, David?
So there was a lot of pushback from that, and many of you would have seen that our own David Whiscombe actually was at the forefront of highlighting some of the problems.
Thank you, David.
So thankfully, and to their credit, HMRC have listened to this, and they have introduced an alternate definition. They haven't removed the first one, but it's now an either or, and I can't imagine many situations that are going to be looking at the former definition. So the or definition is now, in the event of a disposal of the whole of the ordinary share capital of the company, the individual would be beneficially entitled to at least 5% of the proceeds.
That seems to help, doesn't it?
So a couple of points there. Obviously, we're back to talking about ordinary share capital, with which we're all familiar. And then we're simply looking at, do you get 5% of the proceeds? Now, for somebody who's selling independently of a disposal of the entire share capital, this is a notional test. It's would you be entitled to 5% of the entire proceeds if you did sell in the event of an entire disposal of 100% of the share capital. So it avoids this issue about entitlement on alphabet shares, because again, most alphabet shares, you do have the entitlement to capital on a disposal.
Yeah, it's normally just the dividend rights that are discretionary, isn't it? And what's this point about ratchets, David?
Now, there's an interesting, the other area that would have been badly affected by all of this was not just alphabet shares, but it's also in private equity sort of situations where shareholders, the ordinary shareholders, normally hold their shares under some sort of ratchet mechanism where they get a bigger percentage of the proceeds, the bigger the exit proceeds. So often an individual would only reach the 5% on the day of disposal when the proceeds are such that the ratchet operates to give them the 5% on that day alone. So what they're saying here is you actually look at this and you take the proceeds on the actual proceeds on exit, and you use those proceeds for the 2-year qualifying period.
Okay.
So actually, did you meet this 5% test is operated looking back on the basis that it was the proceeds on exit that were applied for the 2-year look back period.
So that's helpful, isn't it?
So it's actually a very helpful provision in private equity situations.
You've had a bit of a kicking of late, haven't they? So surprisingly helpful, but there
Well,
you
it's
go.
not designed to help the managers,
Yeah.
but the actual entrepreneurs who've been funded by private equity could potentially do very well out of this, or perhaps put it more correctly, won't lose their entitlement to ER as a result of this.
Okay. So that's the change that has calmed concerns over alphabet shares, and as David refers to, in equity situations as well. I think we should, just for completeness, mention this hasn't completely done away with the tax risks associated with alphabet shares. You've still got risks under the settlements legislation if you have alphabet shares and are passing the benefit of dividends between husband and wife. You've got risks under the employment-related securities provisions if you think it's clever to give shares to employees with limited rights, but just rights to dividends. Not clever at all. There's a very good article on our website written by David Wiscombe on this, if you care to take a look. But don't just think this is a panacea that's solved all problems with Alphabet shares. It hasn't. It's merely dealt with this issue about entrepreneurs' relief.
I mean, just on that point, it would be interesting to know if the revenue were responding to concerns about Alphabet shares or private equity shares. Because if they have been responding to concerns about Alphabet shares, there's a little sliver of comfort about the more general use of Alphabet shares if actually the revenue have semi-formally acknowledged their existence by making this change.
Okay. All right, so that's where we're going to leave entrepreneurs' relief for now. We've got 15 minutes to go. Let's turn our attention to its sort of first cousin once removed, the new kid on the block, investors' relief. So, David, where does it sort of fit?
I think it's a very interesting question, Anthony. When I was preparing for today, I was thinking, where does this sit in the spectrum, and how should one really think about investors' relief? And to me, it sits between entrepreneurs' relief and EIS relief. And indeed, as we'll see, the provisions draw from both sets of rules, and in terms of the rules applicable to investors' relief. But I think the other reason for talking about it today is not just the fact that it comes on stream on the 6th of April, if you like, but as ER becomes more restricted and EIS has definitely become more restricted, the space that investors' relief occupies between these two reliefs, to my mind, is actually getting bigger. And I think as time passes, more and more people will find themselves, perhaps inadvertently, in the space that investors' relief occupies.
Okay, so watch this space, I think, is the message there. The headline, again, it's a 10% rate of CGT. And like ER, it's got its own standalone £10 million limit. So let's be clear here, it doesn't aggregate with the £10 million limit we're all familiar with from ER. It's a separate £10 million pot, isn't it?
It is, and obviously the 10% rate and the 10 million lifetime allowance is very reminiscent of ER itself. So as I say, as we go through this, there are echoes of ER, and as you'll see, there's echoes of EIS. There's actually no independent provisions on this. It's just an amalgam of the other two reliefs. I think the other thing to bear in mind, and we'll sort of illustrate this in a minute or two, is that investors' relief has standard spousal transfer provisions. So if one spouse qualifies, the other spouse will also qualify, which means, of course, that husband and wife, or whatever counts as a couple these days for tax purposes,
as well,
essentially have a £20 million lifetime allowance between them for this purpose. This contrasts with the entrepreneurs' relief provisions, where you couldn't simply make a husband-wife transfer and hope to double up on ER, because for entrepreneurs' relief purposes, as I'm sure you recall, each individual has to have met the qualifying conditions.
Agreed. I mean, let's just clarify that point. If wife owns shares that qualify for ER and husband owns shares that don't qualify for ER, there is nothing to stop the husband transferring his shares to the wife before a sale, and that shareholding will all qualify for ER, notwithstanding the wife, in my example, has only recently acquired part of the shares. The test is it your personal company throughout the past year? The answer to that question is yes, not have I held all of those shares for a year. So there is a distinction there. Thank you for clarifying that.
But just to follow through on Anthony's example, if the wife in that example had transferred to the husband, then there'd be no entitlement for either party to entrepreneurs' relief.
Yeah.
So while entrepreneurs' relief, you've got to be very careful with spousal transfers. With investors' relief, it's a standard one where, so if you're a couple, you should be, the lifetime allowance is really 20 million.
Okay. So let's, as time marches on, just talk us through quickly the main conditions for investors' relief. And I think we'll find a lot of these are quite familiar to a certain extent, aren't they? As you say, it's a bit of a cut and shunt job. But go on, David, talk us through them.
Okay, so these are the principal conditions. They're not definitive. A subscription in cash into ordinary share capital, with which we're now familiar, from the 17th of March 2016. So if you hold shares that you acquired by way of subscription before that date, they are not qualifying shares for investors' relief. So we are only looking at shares that came into existence from the 17th of March 2016. It's got to be a trading company using the high bar definition that we discussed earlier throughout the period of ownership. So it's not within the last 1 year or 2 year or 3 years in this case, it's throughout the period of ownership. But there are no restrictions on the nature of the trade.
Compare and contrast with the EIS.
That's exactly what I was about to say, Anthony.
Okay.
So if you're dealing with a property development company, for instance, which would be precluded from EIS, it can benefit from investors' relief.
Okay.
Interestingly, you can become a director after subscription, an unpaid director, and the unpaid director follows a sort of EIS type thinking. Or interestingly, an employee after 6 months, as long as it wasn't anticipated that you would become an employee at the time of the subscription. So again, that's similar to but different from EIS. Under no circumstance in EIS can you become an employee. On investors' relief, you can.
Yeah, you can become a paid director, can't you? But certainly not an employee.
Well, it's an unpaid director, but unpaid within the meaning of EIS, which isn't quite the same as it would mean
when
in
I
English.
say, let me clarify. You can become a paid director subsequent to an EIS subscription without losing your relief. I wasn't suggesting for investors' relief you become a paid director. Thank you.
There's a minimum holding period of 3 years, hence the fact that 6th of April this year is the first potential time when one can claim this relief. For those of you who are very sharp-eyed, 3 years from the 17th of March is not the 6th of April. In that one instance, for shares which were acquired between the 17th of March 16 and the 5th of April, the holding period is extended by a few weeks in that nobody can claim the relief before the 6th of April 2016.
Fair point. Well made. Okay.
And then the final one is just be aware the anti-avoidance around this is drawn from the EIS provisions. So they do import the sort of value received provisions from the EIS rules.
Fair enough. So those are the main conditions. As we said, that's not an exhaustive list. You can find the legislation at section 169VA onwards. That's chapter 5 of TCGA if you want to have a look at those in more detail, but those are the headlines. Now, so that's investors' relief. As we draw to a close, let's just have a look at how investors' relief and entrepreneurs' relief can interact, which on the face of it is a bit of a strange marriage, as it were, but let's see what we can do here.
Well, I think to my mind, there are two questions. Can you claim ER and investors' relief on the same disposal? And given that obviously you can become a director or indeed an employee under investors' relief, there's the potential for overlap with entrepreneurs' relief. And then alternately, given that this is a cash subscription into a trading company, why not just claim EIS instead?
Yeah.
So I think that those are, to my mind, are the two questions that just help to place investors' relief, or the answer to those two questions anyways, helps to place investors' relief on the spectrum. So turning to that first question, the answer is yes, you can claim both. And the revenue explicitly acknowledge that in their manual.
A little begrudgingly, to be fair, don't they?
Although they do point out that it's not something they expect to see very often, but they do acknowledge that it can happen. So I've given an example here, and just to be clear, this is not an example from the revenue. This is one I've just made up. So I've got an individual who subscribes for 15% of the ordinary share capital of a qualifying company and becomes a director following subscription. So on exit, 3 years later, and the 3 years is not a coincidence, obviously that's the qualifying time for investors relief, he or she is looking at anticipated gains of 30 million. So what can be done in this scenario? And this, on these numbers, this is just very interesting to my mind. He can claim entrepreneurs relief on 10 million on 5%, which is 1/3 of his holding. He can claim investors relief on 10 million on the second third of his holding. And then what he or she could have done was transfer 5% of the holding to the spouse immediately pre-sale, and the spouse can claim investors relief on the final 10 million.
Wow, I think is the end. I mean, that seems far more generous than I think you would have intuitively expected.
So obviously this becomes very interesting when you start to engage with the lifetime limit. Now, I very much hope this is a problem you all have, and I'm sure you do as well. But if you are beginning to look at substantial gains, this combination of reliefs is beginning to look very interesting.
Okay, and indeed, we should make the point there, with a bit of planning, you could have got another £10 million worth of relief, couldn't you, if the gains were such, by transferring part of the shares to a spouse, subject to her being a qualifying employee or director for
2 years now.
Well, yes, it will be 2 years. So a bit of forward planning, and typically the point was made before, assistant company secretary is good enough for these purposes, isn't it? Even if the individual doesn't really have an active role in the business.
Yep.
So there's plenty we can do there. When you think about it, we were talking before, weren't we? When taper relief first came in, I think the value of taper relief was 8% on £1 million, £80,000. And here we're talking about 10% relief on 30 million with a bit of forward planning, possibly up to 40 million. So far more valuable these days, whatever tightening up or restrictions have been made more recently.
And then I think the other point in this area is hopefully that the package of changes that we looked at in entrepreneurs relief will protect entrepreneurs relief going forward. I've been much less confident about the main rate of CGT staying at 20%. I think that's only going to go in one direction.
Yeah.
And therefore the advantage of these reliefs could actually be increased in the future.
We shall see.
I hope I'm not anticipating anything that's going to happen in the spring statement tomorrow.
Yes, watch this space. So to finish with, let's just have a few brief thoughts on the point you made before. Well, why not go for EIS, given that's a tax-free exit, 30% income tax up front, tax break? If you can, why not?
Indeed, which takes us on to the final slide, and it harks back to what I said a few minutes ago, that EIS is becoming increasingly restricted, or perhaps in policy terms more focused on knowledge-intensive growth companies. Seems to be where the Treasury are trying to take this. I sometimes say revenue when I mean Treasury. It's the revenue, I guess, or just the policeman. It's the Treasury set policy. But if you look at the changes to EIS, they have become very restrictive. And actually, again, when preparing for this slide, the restrictions on EIS are actually contained in section 286, and that now runs from ZA, subsection ZA to M, which is 21 general areas, and each of those subsections has multiple sections behind it of where you can go wrong in an EIS investment. So I've just pulled off 5 areas which I think to my mind are the most obvious ones where you'll be thinking about IR rather than EIS. Excluded activities, obviously all trades linked to land are excluded, and generally speaking asset-backed activities are excluded.
Accountancy and legal services, I'm sorry to say, yes.
Indeed,
but
yes.
There you go.
The gross asset requirements, 15 million is the maximum for qualifying business now for EIS. So any business with assets above that will not qualify. The fairly new company age requirements, if the company is older than 7 years, unless it's knowledge intensive, it will be disqualified for EIS now as well.
Yeah, there's a few get-outs, aren't there? But that's the headline.
The number of employees test and the skilled worker rules. Again, if you are using the knowledge-intensive get-out, then you get out of that test, but bring yourself into skilled worker rule tests. And then probably the one which is the most nebulous, which is the risk to capital requirements, which basically requires that there's a significant risk of loss to capital now. And if you're doing something that's close to the edge, the revenue won't give you advanced clearance anymore in this area. And I always find it rather amusing that the other side of this is, if there's so much risk to your capital that the company's actually not in good health, you can't get EIS either.
Yeah, and it's a bit of a nightmare. And they've also restricted when you can go for advance assurance now, haven't they? You, in theory, have to have specific investors lined up before the revenue will countenance an advance assurance. Now, not quite sure what stops you going to the bloke in the pub and going, would you like to buy some shares? And there's my prospective investor, Mr. Inspector. But there you go.
But I think taken together, and just to reiterate what I was saying, these EIS rules are cumulatively becoming more and more restrictive. ER has obviously been tightened up a little bit. So this hybrid, which exists in the middle, it seems to me, is going to cover a greater and greater amount of ground, and people, whether intentionally or inadvertently, are going to find themselves relying on it more and more.
Okay, right, and that is that, I think. Thank you, David, for enlightening us. So that's investors' relief, where we should start seeing the first claims coming through post 6 April, or the first qualifying disposals post 6 April. That's a tour through some of the thornier points of entrepreneurs' relief and the key changes are announced in the budget. As I say, if you want to know more about either of those two reliefs, we have done previous webinars. They're on our website, in our library. By all means, have a look at that. Thank you for your questions. There's a couple we didn't get round to. Sorry, Graham. Sorry, Adrian. I'll try and respond to you privately on those. Adrian, hope you're having a good holiday. And we will be back shortly with our next topic. If you have any suggestions, feel free to drop us an email or quickly type them in now. But for now, thank you for your time. We will circulate the slides and a copy of the webinar. It will be uploaded to our website. If you can't sleep and want to listen to us again, here's our pretty little pictures. Feel free to log out now if need be. But that's David and me. Feel free to get in touch with us. But thanks. I hope you find that useful. And it's goodbye from me.
And it's goodbye from him.